Good morning, folks. We'll be getting started here in just about a minute and a half, so stay tuned. Happy Tuesday, folks. Welcome to this week's episode of Back to the Futures with me, Markets and Mayhem. Hope you all have had a great trading week so far. It is a holiday shortened trading week, which means you're going to have a little bit of a different environment, less liquidity. Plus, we're post options expiration, which indicates that really between the two of those things, any catalyst can move this market more. So it's a good time if you're going to trade at all to be a little bit more light touch, more careful trade selection, sizing down because you're going to really want to use wider stops, and making sure that you don't overtrade and mess up the last week of the year, especially if you've already had a good year. But really, there's never any reason to lean hard into an illiquid market. So we're getting this episode started. Of course, if you have any questions at any time while we're going, don't hesitate to ask. I will be looking around. We're streaming to a lot of destinations, so sometimes there may be a little delay before I see your question. And of course, with every stream, I do like to emphasize risk management. I think it's one of the most vital parts of your trading journey to focus on how are you managing your risk. And that comes down to position sizing, but it also comes down to how you're planning your stop outs and not taking mental stops, not promising you're going to cut your loss at a certain point, but setting hard stops that are based off systematic analysis of your risk to reward. You've got to be honest with yourself to build that consistency. And that also means being objective, only taking those trades where it makes sense. That is to say, where reward is looking like it's at least 2-to-1 to risk so that it's worth taking that trade. And so also in terms of position sizing, not risking so much of your portfolio such that you still have capital that you can trade. So give me one moment here. There's just one other thing that I need to do as we get this show on the road. I'm just going to switch to the next slide here as I do that. All right, so that's all set. And so I want to talk just a little bit about my journey because I do think it's important for us to get a sense that, trading for most, and I mean 99% of people, is not something that you just start doing and it just starts working right away. In fact, a lot of the folks that get lucky enough to make money right off the bat often end up losing it because they haven't honed that system, that risk management, that discipline, that execution. And also, it's about understanding what works and why it works, really. We can't hope to understand our trading if we aren't actually being accountable to ourselves, if we aren't keeping a trading journal that we can review regularly and understand what trades are working, what trades aren't working, where can we build into our strengths, where can we address our weaknesses. Because ultimately, we won't be able to have any kind of consistency in our trading if we don't understand why our trades work or don't work. If you're just sort of gambling, you're going to get the results of a gambler, which is basically at best a coin toss. Probably worse because you add emotion to the mix. But if you start developing a system to trade around, to manage your risk, to manage your execution, to manage your signal generation, and you're using the convergence of different data to validate your entry and exit, you can start to build into having better results. And that's really the crux of my approach. I'm a much more systematic trader. I was initially a discretionary trader. I found it didn't comport to my personality and my wiring. And I found that actually for most of the students I've coached on trading as well, that discretionary trading, it just tempts too many of the negative and impulsive kinds of emotional responses to the market. Greed, fear, mental stops, saying, oh boy, I'm going to stop out at this point. And then it gets to that point and the mind doesn't want to take a loss. The ego doesn't want to take a loss. The stops move deeper into losses. And it can just be a very self-defeating cycle. On the other side of it, if you don't take a trade that doesn't give you that at least 2-to-1 risk to reward, And if you are sizing those trades properly and you're putting your bracket orders in, so you're having a take profit and a stop, and you step away and you let the trade happen, and then you journal both how you got into it and how it ended up, then you'll both be able to understand what it's like to trade your system without meddling in it, changing stops, changing exits, etc., but also having a journal that you can go back to and be accountable to yourself. Consistency comes from that accountability. It comes from rewiring our mindset over time. So I know I talk about that a bit every week. I kind of give the risk management sermon and the systematic trading sermon, but I do that because A, every week we've got new folks tuning in, and B, these are lessons that we need to continue to appreciate as traders if we want to be successful in this market. I've been doing this for 2 decades. I've been extremely fortunate, but it wasn't in the beginning that everything just clicked and I was just automatically on that journey to success. It took time. It took personal investment into myself. And I will say, for trading and for investing, the best investment you can make is into yourself. There's one other thing I'm going to talk about real quick, and then we're going to move on to some charts. And that is that I know a lot of folks find it tempting to put all of their, capital into one account and just trade it all, especially when you're newer in this game. I'm going to tell you right now that there is a better way to consider. Instead of having everything in a trading account, whether it's a day trading or swing trading account, what you ought to do is set an upper threshold for that account and have that threshold be where you start to take profits out of the account and put it into other instruments, other vehicles. And what I mean by that is take those profits out of those short-term and swing trading accounts and invest them. You can invest them in stocks. You can invest them in real estate, in businesses, in fixed income. Have a diversified approach to your income generation and your wealth building. Don't put it all just on trading. If you're doing well, you ought to roll those profits in and let that money start to work for you while you're sleeping too. It's also a great way to make sure that a bunch of bad trades don't kill you, right? Because you're going to have your hot streaks. You're also going to have your cold streaks. Let's just be honest here. And regimes change and styles have to adapt. So you're also going to have periods where you got to kind of pull back and figure out what's going on and how do I improve my approach, right? Well, if you have those investments in the background, continuing to say generate income, appreciate, etc. over time, that gives you a much better probability of doing well over the long run. It also provides some psychological relief to the pressure of, well, if your only income source is trading and it's not going well, that can create a lot of bad mindset temptations. Revenge trading, sizing up too big, doing things that cause the pain to intensify. And I know there's folks out there listening, nodding in their head like, yep, I've been there before. So on the other side of it, if you're doing really well, you've had a bunch of good trades, and this has been a great year for a lot of traders, including myself, take some of that money, roll it out into investments. What's the problem? It's a much better way than just having it all in one place. So I just wanted to go over that. I know that it's not always the most popular take, but I will tell you from experience and from working with a lot of traders over the years, that really helps with staying power. And good morning out there. Good morning, Kareem. Good morning, Hyper. Hope everyone out there is doing well. Happy Taco Tuesday to all those that celebrate this momentous occasion. Let's go to some charts here, shall we? First, here's a chart of our friend, the S&P 500. And look at what's going on with this one. It is still caught in this range. We're back to the top of the range, so you got to love to see it. If you're bullish on this market, if you're long, which I think the vast majority of people are, even if, you see people talking bearishly, they're still pretty much long. They've got their retirement accounts, they've got their investment accounts, they've got, probably some kind of interaction with the US economy. We're all pretty much long in one way or another. So we do want to see the market move higher overall and the economy continue to grow. So that all being said, foreshadowing, I would like to see this breakout to the upside. We have seen positioning in calls continue to build at SPX 7000 as well. So you can see some of the larger trading desks are really interested in that upside breakout. This is also a week where We are unclenched from the gamma exposure. We're post OPEX, right? So we had the monthly options expiration. We had the contractual rolls for the futures. So we've got some more room for this market to actually move now. We're also in an illiquid trading week. That means there's less buffering to prevent the market from moving. And we are starting to move deeper into positive gamma territory. If you backtest that over time, it typically has some continuation potential to the upside on a swing time frame basis. So there's a lot of things kind of suggesting, hey, we could actually push up out of this zone. The one thing that would concern me a little bit here would just be for all the folks that were on this wild ride that got long up here and then had this big corrective impulse happen, there is this sort of natural predilection psychologically to say, you know what, I don't even want to profit, I just want to get out break even. I'm sure folks that are watching and listening have been there mentally before. Like you kind of go into a trade, you didn't manage your risk very well, it goes against you, you get back to break even and you're just like, okay, I've had enough. Well, if you look at folks that kind of got long this market, let's say in late October, they may be of that mindset. And so what we do is we contextualize that as supply. There is some supply overhead. There are some folks that have been kind of beaten up that might say, I'm going to cash in some here and just kind of, end the year a little more flattened out. I could see that. I could see that being our supply. I still think the path of least resistance is likely to break out of this range to the upside, though. And I do like that we're testing the upside of this range more and more. The more you kind of knock on those ceilings, the more likely it is that they get taken out. So the S&P overall has a pretty bullish setup. And because we've been consolidating in this range for so long, the directionality of this move is likely to be pretty significant. That is to say, an upside breakout is likely to have pretty good continuation. So, 7,000 would be the first stop. But if you continue to see that SPX options activity roll higher to some of those higher strikes, that gives us some other targets that we can appreciate looking into. Now, I will say our friend the NASDAQ doesn't quite look as bullish as the S&P. And we know that there's been some challenges to the generative AI growth narrative that are partially responsible for why this chart looks the way it does. So the NASDAQ would be, I think, the second area that we're going to validate. That is to say, we need to see this thing break back above this uptrend line, ideally on a weekly closing basis. I think Friday closes are pretty important. So I would really like to see that. I don't know if that's going to be what happens this week. It's certainly not a lot of points, or like basically 400, 450 points we have to push higher from. But at the end of the day, if we can make a really concerted push, build acceptance above this trend line, you're also likely to see more bullish continuation in this. It would end up that breakdown was really just an opportunity to shake the tree, get some of the weak hands out. And then once we break back above and trend health improves, you're going to have a lot of momentum traders following along. Segments like CTAs and otherwise that are looking at the health of the momentum and saying, oh, this looks more like a risk to reward ratio that's favorable to my system. I'm going to buy into that. So that's part of what could happen. The other thing is if you start to see anything that improves the narrative around generative AI growth going into next year, you could have some fund managers start to rotate out of those more defensive parts of the market, like consumer staples and healthcare, and back into high beta tech. I wouldn't say we have an all clear yet. We need to see that trend break to the upside. We need to see it ideally on a weekly closing basis. Then we could say, okay, we've got some room for the NASDAQ to probably go to all-time highs as well. Speaking of all-time highs, you love to see it. Look at gold. We talked about this chart last week. We talked about this chart the week before. And really, the 2 weeks ago was when I drew this wedge on this chart. And we talked about gold being in a structural uptrend. All the catalysts continue to suggest that gold is going to keep moving higher. You've got, first, really aggressive fiscal spending. So the government is going out and spending way more money and with unemployment this low than it typically does. So it's historic. And this is not a partisan thing. This has happened under Biden. It's continuing to happen under Trump. It's just the government itself playing a bigger role in the economy And as a result, with all of that new money creation, what are you doing? You're creating competition for existing dollars that reduces their value. So the debasement trade is alive and well. And that's one of the reasons that gold's continuing higher. The other part of that trade, it's the Fed. And it's the turnabout of the Fed to a significant easing posture. And that's for many reasons. It's A, because they've been cutting rates, and they've really been cutting rates for about like 15 months now. But B, it's also because there's this new not QE program that's going to add liquidity on the short end of the yield curve. They're buying bills, the amount of 40 plus billion per month. But also, we have imminently a new Fed chair that's going to be announced by Donald Trump that is likely to be one who's in favor of cutting rates further. Basically, the president wants to kind of tip the scales, influence the Fed to cut rates more. So you've got a lot of reasons to like gold, because when the risk-free rate of return is higher, precious metals have more competition. You can buy these yielding instruments. But when the risk-free rate of return drops and you're creating more money supply, that's an ideal market for continuation. So we've had some of those catalysts play out. We can see it in the way that gold is behaving, and it's hitting new all-time highs here. So I'm probably going to have to revise up my price target for the first half of 2026. We had talked about $5,000 gold. We may have to start talking about some higher numbers here. I mean, the run is strongly suggesting that we could get to $6,000, $7,000 an ounce next year. The timing on that, I'll have to go back and look at some of the flows and some of the other activities and supply and demand, but it is starting to look like that could come earlier in the year with all of this expansion in creation of new money supply, that debasement trade, if anything, not just continuing, but in many ways accelerating. We'll also have to see what this new Fed chair has to say. If they're confirmed by the Senate, they're likely to become what I like to call a shadow chair. What that means is, even though Powell doesn't step down until May, if you announce a new Fed chair in January and they end up getting confirmed, the weight of their words is likely to be equal, if not greater than that of Powell. So while Powell has said he doesn't really see any more cuts happening anytime soon, if the new Fed chair says otherwise, and I mean, geez, even talks about more balance sheet expansion, that's also really bullish for precious metals. And it would also be quite bullish for a lot of the stock market. Now let's take a look at gold's crazy cousin, the white metal we call silver. This thing just does not stop. It is absolutely incredible. This is gold and silver have been big trades for us at Traderade this year as well. These have been areas of the market where we've been paying very careful attention to. We've been early on these trades. I've been talking about them on these streams pretty consistently as well, trying to help as many people gain the benefit of this momentum. Because the primary driver for me wanting to participate in these trades is the momentum. I do like to look at the confluence that the macro backdrop has, as we just talked about with gold, and is similar with silver. But that's secondary. First, you need to see the momentum validate that the trade is real. Then you start to look for other areas where you can continue to validate that trade to gain additional confidence. So that framework is momentum first, and then a top-down macro look at what could be continuing to drive that momentum. With silver, it's not just what we talked about with gold. That's all valid. Silver is kind of seen as a secondary precious metal, but primarily it is an industrial metal. And you are seeing that industrial demand continue to build. It's not just the data center story. It's also the military expansion story. Silver is used in a lot of missiles. It's used in a lot of satellites. It's used in a lot of technology. In fact, it's the best conductor of electricity on Earth. It's also used in a lot of EVs, in solar power and otherwise. And there's a big expansion of that, especially in China, the world's second largest industrial consumer of silver. So there are structural reasons for silver to continue to rally here. Another thing is the US government added it to the list of critical metals. And so that means you've got hedge funds, you've got other folks that want to have exposure to that. So you've got new sources of interest coming in. And if you look at commitment of traders, what's really interesting is even though silver has had this big run, you don't see extremely extended long positioning yet. So from a technical basis, yes, it's very extended, but from a positioning basis, from a sentiment basis, what we can infer is we still may have a ways to go. So initially, my target was between 72 and 75 in the first quarter of 2026 for silver. This run is starting to suggest we could push well beyond that. So again, I will be looking back at the charts and we'll create some new targets for 2026, but it is strongly suggesting that I think silver could get to $80 to $100 an ounce in the first quarter. And I'll come back next week with some more information about some of those targets that we're looking at more closely. And then finally, we've got Bitcoin. And it's doing the exact opposite of the precious metals. Isn't that interesting that the trading vehicle that many call digital gold, I personally don't tend to call it that, but many do, is languishing in an environment where precious metals are absolutely surging to new all-time highs practically at a daily cadence. I will say I personally find it interesting, but I do think there's a rational explanation here. If you look at what's happening in the liquidity dynamics, the very same thing that the Fed has said they want to address by expanding their purchases of bills, that's what is dragging down crypto in a big way. So you look at bank reserves, you look at the reverse repo, you look at other kind of naive measures of near-term liquidity, and they're constrained, and they have been for some time, and it really does correlate with that drawdown that we've seen in Bitcoin. So I think that Bitcoin can get its sea legs back, start to form a bottom and rally when we see those liquidity levels improve. And I think that that is going to correlate with the Fed coming in and boosting near-term liquidity conditions. So you're going to start to see some of those injections, and what you're going to want to pay attention to is those reverse repo operations and the reserves that are parked in banks. The two of those are going to give you a sense as to when that liquidity is becoming abundant, and you should start to see it in the price action of Bitcoin not too far thereafter. I've always looked at Bitcoin as a relief valve for excess speculative liquidity. And we just don't have that excess right now. But when it comes back, and I believe it will next year, that's going to be our big catalyst for this stuff to move higher. Now, let's talk about our weekly pivots real quick. And I'm going to post this out there on social media as well, so you have this for later reference. And just for a heads up, we share these with Traderade members on Sunday night, so you get a little bit more of a heads up about these levels. And I'm going to be adding gold and silver to these pivots coming really soon. So I'm just posting these out on Twitter or X, whatever we're calling it. And folks, if you have any questions as we're going through today's stream, feel free to ask. I know we're on several different platforms streaming this out, so it might take me a moment to get your questions, but I do want to try to answer them all. And I just posted that out there on Twitter, the pivot. So basically, these pivots are programmatically derived. These are automatically generated from an algorithm that I've created that looks at both volume, price action, options, and a number of other variables to determine where the probabilities are of upside extension versus downside extension. So clearly, we are in the bullish above phase for both of these pivots, suggesting that we could still have upside in both the NASDAQ and the S&P 500 from present levels. And I want to share with you all, before we dive into Bookmap, some awesome deals. These are the best deals of the year from both Traderade and Bookmap. So if you want to get up to 40% off Traderade for a limited time, you can use the code Christmas40 at checkout. That's Christmas40 at checkout. Just go to traderade.com, click on the sign up button, and you can use this coupon code. You can also visit traderade.com/bookmap. Scroll down to the special offers and get up to 60% off. So again, best deals of the year. These are winding down at the end of the week. So take advantage if you've been waiting for a good opportunity to do so. And I'll also share these out there on social media for folks to be able to take advantage of while they are live. So we've got just about 4 minutes left until the US market officially opens. We're going to take just a moment to get into Bookmap here, talk about some of the things that we're seeing just over the overnight session into the pre-market. So we zoomed out quite a bit on some of those charts to look at things on a higher time frame. Now let's just take a look at what's happened in the Globex session into this pre-market. So we've had a bit of a drawdown, and just looking for catalysts here. Looks like we got US GDP coming in quite a bit stronger than expected at 8:30 a.m. and that does correlate with that big push lower in the S&P 500. Part of this is likely related to the inference by traders that a strong GDP number makes it less likely that the Fed is going to want to cut as aggressively. Of course, that may not matter quite as much if you've got a Fed chair that's sympathetic with what the president wants, but nevertheless, there you are. So I just wanted to post that out there for folks. But essentially, that's what caused some pressure this morning. I do believe that's also pushing up rates a bit, particularly on the long end. Yeah, you've got the 30-year bond, prices rolling over, rates are moving higher. Same with the 10-year, 5-year, 2-year, somewhat impacted, not quite as much. You still have a healthy rally across metals. Silver, platinum, copper, palladium, all rallying hard. In fact, palladium up 7.16%. I just want to quickly touch on that because we talked about this one getting up to its old highs, and we'll just quickly pull up a chart here. We talked about palladium getting back up to these old highs, which it did, and if it could make a push higher, 2000 was my near-term target. We're getting there very quickly. The metals are making it pretty clear that the inflation story isn't 100% put to bed. That's another thing that's sort of a left tail to look at going into next year. It's great for folks that are invested in the metals and the miners, but eventually some of these costs do push through the system. So it's something we do need to keep an eye on as we go into next year. But palladium absolutely surging, closing in on that 2000 price target this morning. You got to love to see it, especially if you've been long this trade or some of its beneficiaries like SBSW. So the same look that we have in the S&P, and we do see some buyers, by the way, starting to come in here and try to absorb this downside. So let's just zoom in a little bit, and we can see that structurally. So in that move lower, in reaction to the GDP print, this square here, this is an aggressive absorption. And what that's telling us is that buyers were coming in and starting to absorb that downside. So it was aggressive sell deltas. That's what these larger circles, these larger bubbles are. These were basically sellers crossing the spread, aggressively outnumbering buyers, pushing price lower until we got to this absorption. And what happened after that? We started to see some consolidation. The sellers got a lot less aggressive. Then we also had a small-sized iceberg in there. So that's a passive buy of 20 contracts. So what you're seeing is we're getting to a point now where there is some buying appetite after that swoon. And we'll take a look at the NASDAQ. Pretty similar look in the overnight. So we're just going to focus on that reaction function to GDP. And we had a pretty similar look here in the NASDAQ. We didn't see that aggressive buying absorption, but we did see after a sharp move lower, we got right into a demand zone. There's this 100 bid resting at about 25,600. And you'll notice sellers could not show the supply to get through there. Went down, made a low, came back up, went down again, made a higher low. And you started to see a bit of a bid off that low. Now that bid is continuing as the market is opening. So we're going to shift back to the S&P. We do see a pretty powerful bid off that low. That buyer absorption, that aggressive absorption, giving us a little bit of a clue that there was an appetite for risk into that move lower. And then the open, sending that message home a little bit more in a pronounced way. And we can see we're getting above some key levels here. We have confluence between key 3 plus. This is an area of positive gamma exposure or call exposure on SPX. We also have this VWAP under the session volume profile. That's that white horizontal line and the point of control. So you have some convergence here. We're pushing above all 3 of those levels, suggesting we could get some continuation. Now, the other thing to look at is the distribution in the order book. Above, you've got 14,000 on offer. Below, you've got 16,000 on bid. And the offer just shrank by another 1,000. So you've got a delta of 3,000 favoring the bidders, which also tells you buyers are kind of in control of the price action right now. Just looking at auction theory, there's more demand than supply where we are right now. And I'm going to take a quick look at the S&P 500 heat map, and I'll share this with you all. All right, so we're going to pop this on screen just real quick. This is the heat map this morning. Pretty distributed bid across the market, but you'll notice weakness in consumer defensives, in healthcare, a bit in utilities, and strength more in tech, financials, industrials, energy. That's a risk on bid. It's a bid more into the higher beta parts of the market. So that's the other thing you're seeing. Obviously, we're not going to draw massive conclusions from that because it's a holiday trading week. You're going to get these exaggerated reactions and you're going to get some wonky flows. But at the end of the day, for today's trading day, that suggests more of a risk on appetite. Loki says, "Good morning, Mayhem. You changed my life, man. You don't even know it yet." Hey, you know what? If I'm able to help people do better in these markets, that's why I do what I do. I was fortunate enough to have some great mentorship early on in my journey of trading. I met a lot of awesome people in the industry, and they helped to really steer my journey. And I just wanted to pay that forward as much as I possibly could. I've been really having a great time overall in trading, in investing, both in terms of, being able to be successful, but also in terms of applying knowledge and seeing how that improves my process, automating different areas with technology, building tools to help traders take advantage of different things that can sharpen their edge in these markets. So that's incredibly rewarding for me to hear. Thank you so much. And Kareem says, looks like an inverted head and shoulders. Yeah, it did have a bit of that look earlier, for sure. And Loki asks, is part of the reason why gold is going higher thanks to fun guys doing some window dressing? I think a lot of that's already over. A lot of these guys are already on vacation. I think that gold can just sort of continue the path of least resistance, as can silver and these other metals. When a lot of the trading desks are idle, you have less people in the order book, the moves get exaggerated, and there's already this natural buy the dip mentality in all of them. So I just feel like we're getting exaggerated moves into the end of the year in a lot of these markets. What are the perks of the Discord? So we've got live educational streams. We've got some pretty awesome trading tools for examining gamma exposure across all variety of instruments, whether it's the indices, ETFs, and single stocks. And we've got ways to track the order flow in the S&P 500 that are pretty unique. These are all tools I've personally built, as well as a really powerful bot named Gurr that can help you sort through a lot of the different charts and indicators in the market. So it's kind of like having a lot of that information distilled for you. We also have pivot levels that are drawn in real time on a swing and intraday time frame for the S&P and for the NASDAQ. And we have our own research and analysis from myself and my partner Aisha that talk about what's going on, what we're looking at in the markets. We've got trade ideas. We look at commodities, futures, equities, sectors, industries, regions. It's really a great community. Plus, that's the other part. We've got a great community of folks to network with, to bounce ideas off of. You can learn more visiting our website at traderade.com. We've got a whole video I just made kind of introducing you to the Discord. So check that out. And I've got a question. What is the threshold for aggressive absorption? That's actually an indicator that I built. So I'm not going to give away the internals of the indicator. I'm just going to say that's also that aggressive absorption and exhaustion indicator is also exclusively available on the Traderade Discord for the S&P, the NASDAQ, gold, and Bitcoin. And Zen says, wanted to go long pre-market, didn't, and now feel it's too late, have to wait. Look, at the end of the day, that's not a bad thing, Zen. We're looking at the 20-minute opening range. We're also looking for where flows begin to form. So there's still yet likely another opportunity here. I would say we're going to want to wait till about 9:50 a.m. We can define that opening range, which looks like it's going to be pretty broad. So far, we've got like a 20, almost a 30 handle opening range, like a 29 handle opening range. So this is likely to be a dynamic trading day. The fun may not be over at all. We could get some pretty good extensions and moves off this. So let's see how that range forms and which way of it we break, likely to the upside given the price action so far. I also say we are starting to see some iceberg selling happening here that is reducing the ability of buyers to continue to push higher, at least at this time. And folks, if you're enjoying the stream, share it out with your friends, give it a like, subscribe if you're on one of the YouTubes. Michael B says, good morning. Good morning, Michael B. Can you comment on your trading timeline as compared to your investing timeline? Yeah, I'd be happy to. So I have two time frames I trade. I trade intraday and I trade swing. Intraday is self-explanatory, like I'm closing out that entire book at the end of the day. Swing time frame for me is anywhere between a few days and a few months. It often ends up being a matter of weeks to months. Investing is years. I mean, I'm looking at anywhere between, I would say, 1 and 5 year time horizons for most investments. Some go in the so-called forever portfolio where I just continue to accumulate as long as my thesis is intact. So let me know if that's helpful to you. And we're going to zoom in this chart on the S&P just a little bit more so we can zoom in on the near-term price action. Also, I just want to take a quick note that yesterday's most active call strike, 243,000, that was a lot of flow. That was probably some of the most flow we've seen in that most active call ever. And we're talking about also a composition that's changing in that flow. It's about 60% zero DTEs or options that expire the same day. And the SPX or the S&P 500 index options, they trade about 1.3 trillion in notional on a daily basis. They've really become the tail that wags the dog. If you're not watching the flow in the options market, you're missing out on valuable signals, and not just at the index level, but also in a lot of the more popular optionable stocks. It's one of the reasons I built tools specifically to track that flow, which are available on our Discord. You can also plug in the SPX options visualizer directly to your bookmap or motive wave charts. Visit traderade.com/SPX to learn more about that. Getting closer to the session highs here. And what a turnaround. I just want to zoom out a little bit more for a second because we had that negative reaction to the GDP number. We formed a beautiful rounded bottom off that. And then once the market opened, we really haven't looked back yet. So, what a head fake that was. And we're getting right back up to yesterday's hot call level. That's not much of a coincidence. When you see that much interest in a price level, we're likely to revisit it again. Oh, and low key, one of the things you're asking about, what are the perks? The other thing is all that analysis on commodities like precious metals that was shared first on the Discord way before I shared it publicly, way before this thing really took off. So, members are able to take advantage of that, as well as my investing idea in Rio too. That is a junior gold miner that is up what 370% year to date. That's the kind of analysis we share because we do want our members to be able to benefit from what we're talking about, not only for their education, but also for their personal journey into financial independence. And we are pushing to new highs on the S&P. Let's quickly check on the Nasdaq, then we'll look at gold and silver here as well. Nasdaq also pushing to new session highs here. We're going to do the same thing, kind of zoom the chart in a little bit more, but you can see in that last chart, same look on that GDP head fake. We had that kind of push below and then a rounded bottom, and we broke out in that opening move. Now just consolidating those gains. Like to see this stay above the call wall and the point of control, ideally, for the NASDAQ. Let's take a look at gold here. Gold doing a bit of the opposite, selling a little bit off the open. But I am not too disappointed to see that. I don't mind seeing the precious metals consolidate a bit. And gold still bid up about 1/3%. Silver also coming off its highs here, making new session lows in the New York session, but also still trading $69.31. So seeing this come back after the move it's had, not too concerned overall. Personally, if it was up to me, I'd like to see silver consolidate to build some healthier market structure. That would be the ideal scenario for me. And then Bitcoin trading around 87,000 really has to hold around these levels. I don't want to see it go too much lower. If it does get below 84,000 on a weekly close, I do think we've got a kind of basically a lower high forming that's likely to roll down to some of these lower levels we haven't seen in a while, like 70,000, 75,000, I should say, would be my next target if Bitcoin closes the week below 84,000. Let's go back to the S&P. S&P showing relative strength versus the Nasdaq. That's another noteworthy thing that we're seeing so far in today's trading. And what I mean is the S&P is continuing to poke at those highs. The Nasdaq not quite as much strength there. It had a big push at the open. Now it's consolidating while the S&P looks just a little bit more bullish near term. But both look good. Don't get me wrong. Order book in the Nasdaq also pretty balanced here, 3.1 thousand versus 3.4. S&P 16,000 to 14,000. So buyers still have more of an edge in the S&P than the Nasdaq near term. Nice push here. And we could see there is a call wall above. This is likely to be an area that provides some resistance as well. And see there was a small size iceberg just dumped into that move, 280 contracts. You can see that on the subchart as well. That's not something I'd be terribly concerned about. I start looking at icebergs with more seriousness in their ability to put a cap on price when A, they're thousands, and B, you see a kind of immediate visceral reaction from the market going the other way. So far, we haven't seen either of those. You're welcome, Michael. Michael asked, do I have an opinion on uranium? I will say my partner follows it more closely, and she is quite bullish. We do both believe that nuclear power is a big part of the energy picture moving forward. There's really no way around it. Um, so I think from a swing time frame to investment time frame, it's still an area where one can be bullish, but we just have to be cognizant that there's a lot of optimism there. So, if you haven't yet built a position into it, probably best to give it some time to consolidate or correct. But if one is already long, you know, stay along for the ride. In our opinion, that would be what I would be doing if it was up to me. And still, buyers are showing aggression here. We're starting to see call flows coming in as well in the SPX options visualizer. So far, the most active call strike is more active than the most active put strike. And then across the chain, we also see calls transacting more than puts. So far, and it is very early yet, but so far, a bullish look in the flow. So that gives us a sense here that as we're building this 20-minute opening range, we do have some upside targets to monitor. So we'll check back on that. I'm just going to zoom this back out just a little bit more. But so far, nothing really to deter these buyers. So I know a lot of the time when there's a big move that happens, and we even had this in the chat, you can feel like, hey, I've missed the entire move. There's nothing left to trade. I would take that the other way and say you can still apply your traditional frameworks for analyzing what's happened and what that implies could continue to happen. In this case, yes, it does seem like we've had a big move. We were negative, we went positive, but zoom out a bit. S&P's just up 0.15%. It's not a very big day yet. NASDAQ's just up 0.2%. Realized volatility levels, they've been pretty low. But if you look out at VIX, which is also quite low, it still suggests you could have intraday moves about 0.8 to 0.9% either way a day. So if we're trading, now it's 0.2% higher on the S&P, and vol still suggests you could have a move that's 4 times larger than that. Is the move over? It may not be. So that you've got to kind of zoom out, keep an open mind, because this could still go up. We're also in a week where seasonality, for what that's worth, I know it hasn't been a great compass this year, but the Santa rally is sort of in its early innings. So that seasonality that happens this week into next week is pretty strong. And I think we can see it playing out before our very eyes. Maybe this particular seasonality this year has some applicability. Could see the calls are building up here. Let's look. Now, this is a pretty interesting situation that also really does suggest continued upside. Hot put, 2,000. Warm put, 2,000. Hot call, 4,000. Warm call, 3,000. So the calls are trading with plenty of excess volume versus the puts. That also gives us a sense, with the momentum as a backdrop, that we have those as potential upside targets to watch. We have formed the 20-minute opening range, and boy, it's a pretty big opening range here. Talking about like a 27 handle opening range, I usually like to see, around 15 or higher. Even 12 and higher is decent in a slower market. This suggests this could be a very volatile but exciting and dynamic trading day. The bigger the range, the more likely you're going to see range expansion of a similar size. And you could continue to see that call flow building here. So 6,000 on the hot call versus 4,000 on the hot put. We are seeing just a little bit of selling here, and we are seeing some supply come in overhead, but ultimately it looks more and more like this can resolve higher by about 15 points. And I will say, with this hot call, I don't want to get too much more aggressive above here because we also have the call wall around that level. This is basically looking at this at 6,900 SPX, okay? So if you're trading SPX and you're not trading the futures contract, you need to map the delta. The futures are going to trade at a premium to the index. That premium is around 55 right now. That means that our call wall is at around 6,900 SPX. That is likely to be an area of formidable resistance overhead. Does my so I got a question from Alex. Does your options level update on the fly? Yes, it does. Update on the fly. It updates every 2 minutes, both the levels and the volumes. And it is my own product. I actually built the algorithm, and I have the whole thing kind of set up through its own API. So when you set up with it, you're getting data directly that's been processed by the SPX options visualizer. And it's coming right from the exchanges. So he asked, Alex continues to ask, is the same base and logic with spot gamma? I'm not familiar with the internals of their product, so I couldn't answer that question. But I can say that with confidence, having tested them side by side a bit, I think you're going to find some more value in the way that the SPX options visualizer works, especially with the cadence of the updates and the way it blends both zero DTE and longer chain analysis. And look at the hot call, 11,000 versus 7,000 on the hot put. So continuing to see that flow build at those higher strikes. We're just going to zoom in a little bit more here as we round out the session, about 7 minutes left on the stream. Another question, can I get the stops and icebergs add-on for Bitcoin? I do not believe it is available for Bitcoin because I don't believe the data feeds for Bitcoin are rhythmic based, but I would let the bookmap team field that question. And Michael says, perfect, thanks, I am long. You're welcome, Michael. That was too a different analysis earlier, but I'm just going through all the feeds and making sure I don't leave anyone behind. And seeing some consolidation here in the S&P, which is good, builds us a little bit of structure, starts to build us some levels we can look back at if we get pullbacks from higher levels. We are seeing some exhaustion in Bitcoin. I'm just going to flash over to this real quick. So Bitcoin just had a bit of a swoon Getting a pull here, but we are seeing a little bit of seller exhaustion. That's another indicator that is on the Discord that we talk about with the audio alerts as well as the visual alerts. And basically, it just suggests that you've got some really, really aggressive sweeping going on. And sometimes that can lead to a bit of a near term reversal. Obviously, we're not seeing that play out in Bitcoin right now. This is a pretty motivated sell. Let's just take a look at the rest of the crypto space here. And we can see that's actually in pretty much everything one might monitor. Bitcoin, Ethereum, Solana, all seeing a pull here. Let's check on our friend gold. Gold, not so much. Gold sort of building a base here, it looks like. Similar look in silver, consolidating off its lows. Let's take a look at the NASDAQ. NASDAQ retesting the point of control here. Seeing some resistance at and just above this call wall. And S&P rolling over a little bit here may join its friend the NASDAQ, retesting that point of control. Now, for folks hoping for just up, up, and away, actually seeing things consolidate a bit more is a healthier look. What we don't want to see, however, is this confluence area between the point of control and this large aggressive buyer delta bump out in the session volume profile. You can see that around this 76.30 mark. What that tells you is that's where a lot of folks were buying contracts, many of which we can infer were to get long. If we did push below that level, the further below we go, the more likely they are to become motivated sellers. Because if you think about it, that's their sweet spot and above, right? That's where most of those contracts were bought to get long. So if you go further and further away, you're going to start to mechanically trigger stops. You're going to have folks that are just managing their own stops start to also get a little more scared about that and want to take some of that exposure down. So what we want to see is things balance out around here, which we're starting to see maybe a little bit of a bid come back, but you want to see things balance out around this point of control and continue higher. Not only does that accomplish some consolidation, which we could use after a move of that scale, but it also would give us some more healthy market structure, a place to fall back to if we get back up here to the hot call and then retrace. Continuing to see that selling pressure in Bitcoin. Just going to flash over to that real quick as well. Seeing another exhaustion print here in Bitcoin. Buyers are making an attempt to bid from here, but this has been a pretty nasty draw in Bitcoin so far. But we can see with this exhaustion print, one thing did happen. The selling pressure stopped pretty much right as that printed. So that's often what you see in one of those exhaustion prints. Obviously, it can't happen every single time. No indicator's got a 100% hit rate, but this one's got a pretty solid one. And this exhaustion print so far is at least showing us that maybe they got a little ahead of themselves on that move lower. And I'm going to flash back to the S&P 500 here. So I would like to see us maintain above this point of control, consolidate, build acceptance above the top of that opening range, and then make a run to the hot call. That would be my ideal bull scenario. It goes out the window if we get below this point of control and can't stay above the VWAP, because you're going to start to see more and more of these people that were longing in around 69.30 start to get nervous and mechanically or on their own just stop out of that trade. So far, I still think the bulls are in favor, but that's my line in the sand. I want to thank everyone for tuning in to this week's episode of Back to the Futures with me, Markets and Mayhem. I want to wish you and yours a warm and festive holiday season, a Merry Christmas, and if I don't catch you next week, a Happy New Year. I'll see you soon.